Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, president of InsideTrack.com. Eric, welcome back to the show.
Oh, thanks for having me back, Jim.
What kind of impact are global markets having on the U.S. equity market, considering that people like to find early warning signs?
Well, I've been watching several different markets, some of them remaining very positive, so not really showing much of anything. But there are a couple out there that are at least giving me pause, and it's one of those things that if they're in a normal correction, then, usually just stays contained to whatever market that is. But in those rare times when it exceeds the norm and kind of breaks into more of a meltdown type of thing, well, that's where you get the contagion going through the global equity markets. And for multiple reasons, I'm keeping my eye on China and Shanghai Composite. Not that that's normally looked at as a leader or anything, but it obviously has an impact on global economies and resources, depending on how and what they need to react to. But the interesting thing, if I can step back one step, is that for the last 2 months, I've talked about how I thought that our markets, and some of it was some developing divergence between like the Dow transport versus some of the other markets. Some of it was based on cycles, some of it on specific indicators that I have leading into an expected topping formation. But all that together was leading me to conclude that the period from March through June of this year had the potential to be similar to the period of May through August of 2015. And in that time frame back then, you had the transports peaking before any of the other indices. Then you had the Dow and most of the other U.S. indices peaking in May of 2015. And they went through a couple months of just sideways, up and down action, trying to retest their highs a couple times. And that lasted pretty much through June and even into early July of 2015. And then you saw a bit more of a downdraft start to take hold in mid-July and then again after early August. But bringing that back to the discussion on the international markets, at the same time back then, you had the Shanghai Composite. Now, at the time, it was really finishing a parabolic move up. The final stage that only lasted maybe 3-4 months saw it tack on more than 50% to what had been its value, rallying from roughly 3,400 to 5,400 in just a few months. But that bubble burst very shortly afterwards, and is really what's attributed as the source or the origin of the meltdown that we saw in August of 2015. There were a lot of other factors contributing, but that was the one that really was kind of the straw that broke the camel's back. And the Shanghai dropped from 5,400 to about 3,000 in a matter of a little over 2 months. And again, that was what really triggered a more accelerated sell-off in a lot of our markets. So so what I should point out too is, in that case, the Shanghai peaked about a month after our markets. It peaked in early June, whereas most of ours had peaked in early May, and then began this 2.5 month sell-off. Well, here again we come into this current time frame that I thought could be an analogous period, and you had the Dow Industrials and the S&P peak on the first day in March. They've since gone back up and tried to attack those levels. The Dow Industrials and transports and some other indices have not retested those highs. And a month after that March 1st peak, all of a sudden the Shanghai peaks in early April. And now over the course of the last 4 to 5 weeks, you've seen a moderate sell-off in Chinese equities, but it's kind of the biggest sell-off that they've had in several months, and it's now to kind of a make-or-break support level between 3150 and 3250 on, and this is the XGY market that I'm watching, the Shanghai Class A Index. So between 3150, 3250 is a measure of 6 to 12 month support. It's the intra-year lows. It's kind of the difference between a normal correction and, if it drops below that, starting to show signs of a more significant correction. So I just see a lot of these things coming together. None of them have yet triggered any cause for alarm. But the fact that they are so close to those points, they need to be watched even closer. And it's one of those things that really demands day-to-day monitoring and seeing if there's any additional warning signs or yellow flags that come up as a result of that.
We'll have more with Eric Hadik right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Eric Hadik. Eric, U.S. equity markets, mixed signals right now. The NASDAQ and S&P 500 did have record highs last week. What does that tell us?
Well, there's definitely many of the indexes that remain strong, and the NASDAQ 100 has certainly been leading the way. At the same time, as I've mentioned before and even alluded to in our earlier conversation there, was that the Dow Transports historically give some early warning signs, and they often peak several months before the other indexes. You can even go back to the 1999 and 2000 peak, where the transports topped out in May of 99. The industrials didn't top until January of 2000, and then the S&P and NASDAQ actually spiked to new highs in late March of that year, of 2000, before everything entered a 2-year bear market. And then when we came into this period back in 2014, 2015 that I was just discussing, The transports topped in November of 2014, months before the other indexes, and they were already starting to give some early warning signs of what could be coming. Well, here again, the transports are giving some early technical signals of a reversal and a breakdown, and they have multiple times dropped to new intra-year lows, which is a significant gauge of an intra-year trend and 3 to 6 month trend. And there's an important channel/moving average indicator that I use that is poised this week and it's a longer-term lagging, longer-term meaning multi-month in my work, but it's more of a lagging confirming indicator, and it's in a position to turn down most likely this week. And that would be an additional validation to what the transports have been showing. So if that happens, and if the transports can confirm the initial sell signals they gave in early March, then I would start watching the other indexes to give signs of that. And the way I've described it in my publications numerous times, I look at these indexes, both domestic ones and kind of the divergence you get between them, but also domestic and international. And when you are poised for a significant sell-off, it's kind of like an old wooden roller coaster getting to the peak of the first hill before the real significant drop. And the front car peaks and goes over the top long before that back car ever makes it over the peak. And until all the cars have made it over that top and summited the peak, you can't really have the accelerated sell-off. And it's once that last car finally peaks, finally starts to turn down, that then you get the downward momentum and you get all the cars moving in the same direction and at the same speed. And that's what I see a lot of times in the overall equity markets. So I'm often looking for signs of that first car to going over the peak, but not getting too impatient, waiting for the others, that those others are still climbing and their uptrends still need to be respected, but you need to be monitoring them a little closer for any signs of kind of a chink in the armor or a weakness in their bull market. So that's how I'm kind of viewing the S&P 500 and the NASDAQ 100. Right now, they remain strong. They remain pretty solid. Every day they set up kind of different parameters that I'm watching for where an initial breakdown point would be triggered. And if that happens, and most likely if it coincides with something like the transports giving a more significant sell signal, that's when you really have to be aware and start looking for a little bit more convincing move to the downside.
Now, would something like the United Airways or United Airlines incident be the trigger for transports to fall?
Well, that's something I think it was you and I discussed a month or so ago. I know I did in a couple of interviews I did, but just kind of throwing out there as a for instance, not trying to attribute too much significance or too much weight to any one incident, but often when you look back 6 to 12 months later, you can kind of pinpoint that final straw that was thrown on the camel's back and finally did create a bit of a breakdown. And the hypothetical scenario that I just painted then was, what if you have an incident like that then triggered, every time you get something like that, politicians want to overreact, and not only overreact, but each one wants to outdo the previous one that's gotten in front of the cameras, and do some sort of regulation or some sort of penalizing that just really more than anything assuages the public and tries to pacify them and show that the politicians are doing their job, always being Johnny-come-lately and always reacting after the fact instead of being proactive. But if you get some sort of legislation, some sort of regulations that really restrict the overbooking, because that was something they were initially blaming that whole incident on. Now it later turned out it wasn't exactly that. It was more that they had crew that had to get to, I think it was Kentucky, to be staffing other planes, but it was still a function because of the plane being booked to the max, which, from a corporate standpoint, obviously you want to do what's in the best interest of your bottom line, as well as making sure you're taking care of your clients and passengers. But if we suddenly get legislation that starts to really curtail what they can do as far as booking, and which is what they claim, they need to give that, I don't know whether it's 20% or whatever the numbers are, overbooking, in order to have the planes close to maximum capacity, all of a sudden they get something that's restricting their profitability and their ability to make money. And so then you see a reaction in their stock prices, and all it takes is the regulation even being discussed, and the markets are always anticipating things, so you'll get traders looking at that, looking at what its ramifications could be down the line, and starting to sell long before the legislation's passed and long before it actually starts to impact the bottom line. And then you might get that type of thing where it ends up being the incident that helped the market break some key support, so then you have more of your computerized and program trading kicking in, and it's that proverbial snowball heading down the hill. So it very easily could be something like that. It could be something completely different or out of left field that just is enough to spook the market and have it break down certain key levels where, to some extent, it becomes a self-fulfilling prophecy in the market.
Well, now anything to do with an airline ends up on the news.
Exactly. So then that makes it seem like things are so much more egregious than perhaps they really are. I'm not, making judgments one way or the other, only that this happens so frequently in such a diverse array of areas and arenas. May have nothing to do with airlines or transportation whatsoever. You just get the same pattern of never anticipating a problem that could be fairly obvious sometimes, and then you finally have the inevitable problem, and then you have the overreaction to it. And then there's an overreaction to the overreaction. And that happens so often in politics and in the markets that it's not out of the ordinary to anticipate something like that, and as you say, to start noticing it in the media, in the general public. And so it would only take another incident similar to that, or something else that blemishes the public's view of the airline industry, and all of a sudden you've now got the synergy of negative factors weighing on those markets.
We'll have more with Eric Hadik right after this.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J. on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Eric Hadik. Eric, what's your read on gold right now?
Gold has pretty much fulfilled what we even talked about a couple weeks ago and a couple weeks before that I thought we would see a sharp sell-off into early May, and that the gold stocks, in particular the XAU index, needed to spike down to new intra-year lows in order to complete the minimum expectation that I've had since early February of an ABC type of drop, a decline, then a partial rebound, then a new decline, and in order to give the minimal fulfillment to that, it needed to at least drop to new intra-year lows, which that index did on May 4th. And so that set it up for a rebound. Gold and silver have come into critical support levels around 12.15 to 12.25 in gold, and right around the $16 level in silver. And so everything is set up for a brief bounce, but there are reasons that I've elaborated in my recent monthly newsletter why I think that those markets could see new lows leading into mid-June, and there's even a scenario that I'm going to be elaborating on in the near future on where that decline could stretch farther into the second half of this year, particularly in the gold stocks. The metals themselves, I need to really see what they do here in the next couple of weeks to see if they signal that breakdown or not, or whether it's gold stocks diverging as they often do and heading to even lower lows later on in the year, even if gold and silver are holding their previous lows at that time. But one of the really interesting things that I've seen in silver and written about for the last couple of years, it has had this very consistent pattern, and it's a pattern that's discussed in some old technical work of W.D. Gann back in the 1920s, and it basically is markets kind of trading in block ranges. And what I mean by that is if you take a silver chart and you look at the last few years, and you'll notice that many of the moves, they vacillate within these $2.50 ranges. And if you just pulled up a weekly chart or a monthly chart of silver for the last few years, and you drew horizontal lines at $13.50, $16, which is $2.50 higher, then $18.50, then $21, and even continuing it up to $26, $31 on the $5 multiple that I'm talking about there, you'll see that almost every one of the major turning points and trading ranges pivoted off of those levels. And when we were dropping last year, when silver peaked in early July and then a secondary peak in early August, I kept talking about that there were multiple reasons, but this range trading was one of them, why I expected silver to drop into late 2016 and to get back down to the $16 range. Well, sure enough, it plummeted into late December, got down to $16, and turned on a dime as soon as it did that. When it did that, I said that we should look for a rally back up to the 1850 level, and that it wouldn't surprise me at all to see silver be contained by that, to see a couple tests of that level, and then ultimately work back down to the $16 level. Well, in late February, silver peaked at right around $18.50, sold off pretty sharply, then it rallied back into early April, tested the $18.50 level again, and then the bottom dropped out. Well, we're now getting right back down to that $16 level, where you'll probably see some support take hold again. And again, I don't trade off of just one factor like that, but when I see something like that being just so uncanny in a market, I also don't ignore it. And when there are other factors corroborating that, and most notably when silver gave this very powerful weekly sell signal on April 21st, that was kind of the final confirmation to me that we'd seen a top, we were going to see this sell-off into early May that I was discussing, and that ultimately silver could get back down to that $16 level. So I think we're going to see a lot of continued volatility and range trading for several months, and I think there's going to be some good opportunities on both sides of those markets, both buying and selling. But it's not until a little bit later in the year that I think we could start to show more signs of a new bull market taking hold.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. You're listening to HowStreet.com Radio. Any questions for us or our guests can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.